Welcome to Smart Dollar Mindset, the channel dedicated to helping you achieve financial freedom with smart money habits and investing. Today, we're going to tackle one of the most common questions in investing: index funds versus ETFs. What's better? If you've ever tried to start investing, you've probably seen both of these options thrown around everywhere. Some experts swear by index funds. Others claim ETFs are the future. But the truth is, both can be powerful tools for building wealth. The key is knowing how they work, their differences, their strengths, and which one fits your financial goals and lifestyle. By the end of this video, you'll know exactly how both work, what sets them apart, the mistakes to avoid, and most importantly, which option might be better for you. So stick with me until the end, because this could completely change the way you build wealth over time. Let's start by understanding the basics. Both index funds and ETFs are what we call pooled investments. That means instead of buying one single stock, you're investing in a basket of different stocks. This gives you instant diversification. For example, if you buy a share of an S&P 500 index fund, you're essentially buying tiny pieces of 500 of the largest companies in the United States. The same applies to an ETF that tracks the S&P 500. So at their core, index funds and ETFs are very similar. They both track indexes, they both spread your money across many companies, and they both give you access to the stock market without the stress of picking individual stocks. But their differences matter, and can impact your returns, your convenience, and even your taxes. One of the biggest differences between index funds and ETFs is how you buy and sell them. Index funds are typically bought directly from the fund company or through a brokerage, but they only trade once per day at the market's closing price. That means if you put in an order at 11 a.m., your purchase won't go through until the market closes, and you'll get whatever the end-of-day price is. ETFs, on the other hand, trade like stocks. You can buy and sell them throughout the day at market prices that change minute by minute. If you want to buy an ETF at 10 a.m. and sell it at 2 p.m., you can. That flexibility appeals to many investors, especially those who want more control. But here's the catch: that flexibility can also be a trap. The ability to trade ETFs all day long can tempt investors into buying and selling too often, trying to time the market, and chasing short-term moves. And as we all know, frequent trading usually hurts long-term results. Index funds, by trading only once a day, actually protect you from that temptation. They force you into a more disciplined, long-term approach. Let's talk about costs, because fees are one of the most important things in investing. Both index funds and ETFs are famous for being low cost compared to actively managed mutual funds. But ETFs tend to have a slight edge here. Because ETFs are passively managed and structured efficiently, their expense ratios can be extremely low, sometimes as little as 0.03%. Index funds are also cheap, but they can sometimes be a little higher, like 0.10% or 0.20%. Now, you might think, that's only a difference of a few cents. But over decades, those fees add up dramatically. Imagine investing $100,000 over 30 years. At a 7% return with a 0.05% fee, you'd end up with almost $740,000. At a 0.20% fee, you'd end with about $720,000. That's a $20,000 difference just because of fees. So while both are cheap compared to old-school mutual funds, ETFs generally have the lowest costs. Now, let's dig into taxes. ETFs tend to be more tax efficient than index funds. Why? Because of the way they're structured. ETFs use a process called the in-kind redemption mechanism, which basically allows them to avoid creating taxable events when investors buy and sell shares. Index funds, on the other hand, sometimes have to sell stocks within the fund to handle redemptions, which can generate capital gains that get passed on to you as the investor. That means you could end up paying taxes even if you didn't sell your shares. Of course, this only matters if you're investing in a taxable account. If your investments are in a Roth IRA, traditional IRA, or 401k, taxes aren't an immediate concern because of the tax shelter. But if you're investing in a regular brokerage account, ETFs often give you an advantage here. Let's look at accessibility and minimums. Index funds often require minimum investments. For example, some Vanguard index funds have a $3,000 minimum to get started. For some beginners, that's a big hurdle. ETFs, on the other hand, can be bought for the price of just one share. If an ETF trades at $100 a share, you can start with $100. And thanks to fractional shares now being offered by many brokerages, you can sometimes invest with as little as $1. That makes ETFs incredibly beginner-friendly. But there's another side to this. Automatic investing is easier with index funds. You can set up a system where every paycheck, a set amount automatically goes into your index fund. That consistency is powerful because it allows you to set it and forget it. With ETFs, automatic investing is trickier. Because they trade like stocks, you often have to place a manual order. Some brokerages now allow recurring ETF purchases, but it's not as seamless as it is with index funds. So if you're the type who wants ultimate simplicity, index funds are often better. If you're more hands-on and like flexibility, ETFs might win. Let's talk about liquidity and trading volume. ETFs are extremely liquid because they trade on exchanges. That means you can usually buy or sell them instantly, especially if you stick with popular ones like the SPY ETF for the S&P 500. But some niche ETFs with low trading volume can have wider bid-ask spreads, meaning you pay a little more to buy and get a little less when you sell. Index funds don't have this issue, since you're buying directly at the fund's net asset value at the end of the day. There are no bid-ask spreads. So for most people, this won't be a deal breaker, but it's worth noting if you plan on trading frequently. Let me give you a real-life example. Take Sarah, a new investor with $500 to start. She wants to invest in the S&P 500. If she tries to buy a Vanguard index fund, she might face a $3,000 minimum, which she can't meet. But she can buy an S&P 500 ETF like VU or SPY for just the price of one share, or even buy a fractional share. That makes ETFs perfect for her situation. Now, consider David, who works a 9-to-5 job and wants his investing to be totally hands-off. He sets up his paycheck to automatically funnel $500 into a Vanguard index fund every 2 weeks. He never has to log in, never has to place orders, and never has to think about timing. 10 years later, he has a substantial portfolio, all built automatically. For David, index funds are the best option. Both Sarah and David are building wealth, but they've chosen different vehicles that suit their lifestyles. Another important consideration is choice. The ETF market has exploded over the past 2 decades. Today, there are ETFs for nearly everything: broad indexes, sectors, bonds, international markets, even niche themes like clean energy or artificial intelligence. Index funds are more limited. You'll find plenty of solid options like S&P 500 funds, total market funds, and international funds. But ETFs offer far more variety if you want to customize your portfolio. The downside? Too much choice can overwhelm beginners. The simplicity of index funds can sometimes be a blessing. Now let's transition to performance. Here's the truth. If an ETF and an index fund track the same index, their performance will be almost identical. An S&P 500 ETF and an S&P 500 index fund will both give you nearly the same returns, minus a tiny difference in fees. So performance shouldn't be the deciding factor between the two. Instead, it comes down to convenience, cost, tax efficiency, and your personal investing style. Final thoughts: so which is better, index funds or ETFs? The answer depends on you. If you value simplicity, automatic investing, and a hands-off approach, index funds are a fantastic choice. They're perfect for people who want to set it and forget it, let compound interest do its magic, and not worry about day-to-day market fluctuations. If you value flexibility, lower costs, and more variety, ETFs might be better. They're especially great for beginners who don't have large sums to invest right away, or for those who want access to a wide range of markets and themes. But here's the most important thing: both index funds and ETFs can make you wealthy if you stick with them. Both give you diversification. Both keep your costs low. Both help you avoid the dangers of trying to pick individual stocks. The real danger is not choosing between the two, it's not investing at all. Too many people get stuck debating details, and they delay taking action. Years pass, and they miss out on the most powerful force in investing: time. So instead of asking, which is better, ask, which one will I actually use consistently? Because at the end of the day, the best investment is the one you stick with. Financial freedom doesn't come from chasing the perfect option, it comes from steady, disciplined investing over years and decades. Whether you choose index funds, ETFs, or a combination of both, the most important step is to start, stay consistent, and let your money work for you. Thank you for watching Smart Dollar Mindset. If you found this video valuable, make sure to subscribe, like, and share it with others who are on their journey to financial independence. This channel is here to help you break free from financial stress, build long-term wealth, and live the life you deserve, all through smart money habits and smart investing.